Appreciate being here today. It's really interesting, following David's talk and all that's going on in the world, and in the real estate world, and we deal very much in the granular, very much it's a local business, and everything's a lot about local stuff. But you got those overall trends that you have to watch for. So, gotta grab my clicker here. So I'm going to cover a couple different things. I get this question a lot: is it too late, to be in this business? Too late to enter the real estate cycle? Oh, actually, one little thing before I go into what we're talking about. I've been in this business for 34 years. I started with Price Waterhouse. I was a tax manager with Price Waterhouse out in San Francisco. I grew up in Wisconsin, so I ended up moving back to Wisconsin to raise my family. I joined MLG roughly 30 years ago as a CFO and took over the leadership role about 20 years ago now. So I've been living and breathing this space for a long time. So I'm going to run you through the markets and what's going on. So I'm going to hit about some market statistics. I'm going to talk about the capital markets, debt and equity. I'm also going to hit a little bit of the tax side of it because I was a tax guy at Price Waterhouse in my younger days. So people ask me the question, is it too late? And you hear in David's talk, and my answer is no. Diversification is a big deal, and private real estate has a very low correlation rate with other asset classes. And it's not public REITs, it's very different. There's things to be cautious about. Tariffs, we long in the cycle. You need to be cautious, you need to be aware of stuff. What's the ramifications of negative interest rates? We did have the inverted yield curve for a little while there that causes and talks about possible recession. And obviously David's here predicting a recession coming our way. So why is it not too late? Fundamentally, real estate as core is about the basics of demand and supply. Overall, in private real estate, demand and supply is very much in balance. We're sitting roughly 96% occupied in multifamily, 95% industrial, 90% in office. Office I don't like so much. Retail, surprisingly, 95%. Normally in a crowd like this, I'd ask people to raise your hands. Do you think we're 70% occupied in retail, 80%? People always guess 70, 80%, but you're actually 95%, and I'll get into the reasons why that is. The other thing why real estate is different than many other asset classes, it's a very fractured and fragmented marketplace. Lots of players in real estate, and the beauty of private real estate is there's people involved. And people make mistakes, and it's our job as a real estate guy to find those mistakes that we can take advantage of, buy, correct, and cure. Common stuff, and I'm not going to walk through the examples just for time. We can come back to them if we want to get into it. But people don't keep up with the norms in the marketplace. Multifamily, we're like the airline industry. We charge for everything. You want a dog? No problem, $25 a month. You want water? Sure, no problem, $30 a month. And we typically get about $60 to $120 a month in multifamily above and beyond the normal rent. Some property we bought there is only $7 a month in collections. So people make mistakes in our business. There's also missed opportunities. We bought a property up in Minneapolis. The rents were $730 a month. Occupied, 98%, fully occupied. Things are great, But the gentleman that owned the property owned it for 35 years and had not done much to update his asset. You buy the asset, you spend $20,000 per unit fixing it up. We grew the NOI on that asset from $2.5 million to $5.8 million in 3 years' time. We took our all-in capitalization was $58 million, and we sold for $95 million in 3 years. People make mistakes in our business, and again, it's our job to find that. Poor management. Lenders are horrible real estate owners. We bought a shopping center from a lender. The lender the anchor tenant exits the building. For 3 years, it takes them 3 years to foreclose the asset. And the CMBS lenders are the worst because it's really not their money, and the servicers are just acting on behalf of bondholders. But lenders are really poor asset managers, and there's opportunities there overall. People sell off market sometimes. Why would you ever sell off market? When we sell assets, we had an asset in Memphis put up for sale. We had 30 offers on the asset. Why people sell off market makes no sense, but it happens. People do it for a variety of reasons. Both that Westgrove deal and Crossroad deal, we bought off market. One was a $41 million asset. We didn't compete against anybody to buy that asset. The Westgrove property, $36 million asset. We didn't compete against anybody to buy it. So it's there's human error involved, and that's something that's special about private real estate, and why I think it's always an investable asset class because of that. So, multifamily. The multifamily market, we've had a great run, and we've had a lot of growth stuff. But I'm going to run through some of the mechanics and some of the numbers overall. I have a little cold here, so let me get some water here and there. But overall, you've seen rent growth pretty consistently, about 3-4% per year. We're sitting at 96% occupancy, very healthy market. One of the things that the driver behind multifamily, again, real estate at its core is about the basics of demand and supply on a very local level overall. But there's general things that are happening. You have an aging population creating demand. You have people getting married later. Unfortunately, you have people divorcing more often. You have high student loans. Home prices are up. Big down payments required to buy houses. And people always forget there's population growth every year. You got a built-in demand generator that's always there, always clicking along. The interesting thing about this chart is, we see population growth about 0.7% per year, yet household formations are greater than that. So there's things happening that are creating additional demand above and beyond just pure population growth and those factors that I just mentioned. Another thing, the other side of the economic view of multifamily, the supply side. You think we're doing a lot, but if you look historically over the last 50 years, we average about 1.4 million units of single family and multifamily per year. We're still not back to that level. 10 years into the recovery, we're still not back to that level of household formation. So there's a shortage of housing on the single family, multifamily side, and it's very real, and it gets into lots of reasons why that is, but anyways, we're not producing enough product to meet the overall demand growth that's occurring. Last 7 years, housing pricing is up 55%, rents are only up 38%. This one I want to spend a little time on this chart because I think it's people, they think multifamily had this big run. We've had a lot of rent growth the last 7, 8, 9, 10 years. But you have to keep in context what's happened over the past 20 years. My viewpoint is multifamily rent growth should run something along the lines of construction inflation costs. Over the last 20 years, you've seen about 3.4% of construction cost growth in the multifamily, really construction overall. That blue line there is a 3% trend line. The gray line below is actually the rent growth. The rent growth is materially below construction cost growth if you go back 20 years. And the reason I go back 20 years is when we changed from a policy perspective and we started allowing all these low doc loans, anybody could buy a house, didn't matter what your credit was, that created a big chunk of false demand that wasn't a permanent condition for single family. And all these folks were buying homes that really couldn't afford it. So that took away demand on the multifamily side. Multifamily was soft in the early 2000s overall. And then ultimately, you create all this false demand. And what does real estate guys do? They create supply to meet this false demand of single family. And then all of a sudden the markets figure out this is a bad idea, giving all these no doc, low doc loans. And all of a sudden demand crushes. And now you're seeing with this supply factor on the single family side, which was monumental, and prices crash. And then it creates tipping points in the financial industry, in the banks. And real estate is very debt dependent. And so when you have the banks get in trouble, then it has a ripple effect overall. But my viewpoint is if you smooth out the 20 years and you go back to before the whole single family boom, rents have actually are just kind of catching up with what they should have done. It's not the move that we've had in the last 7, 10 years is not really that big of a move if you keep it in the context of what happened over the last 20 years. And I think that this catch-up in rents is just catching up to what it would have been had we not had the poor government policy of easy money for single-family homes overall. And I think there's some room to grow because of the cost side of it overall. Overall, you're seeing occupancies in the Class A's. overall, the Class C stuff, you're over 96% occupied. Class B, roughly 96% occupied. Class A, 95% occupied. Healthy environment overall. The gap, you're seeing the rent growth. The top line there is the Class A rents, about 3.7% growth. Now, the Class A rents have grown more than Class B and C rents. That's logical because costs of construction have gone up roughly 3.5%. So rents for new stuff are going to follow what it costs to produce it. And that's why Class A rents have grown higher. And the Class B and C rents, in my view, lag the A rents because owners are reluctant to raise rents. And I shouldn't say reluctant. Many players in our space manage to occupancy. They want to be 100% occupied. They want to be 99% occupied. So they don't care about having that full the max rent. So rents tend to lag on that side. But I do think there's a gap there. Now, if you look here from a nominal perspective in Class A rents versus Class B, C rents, there's a $480 gap. Now, this is national numbers. Let me clarify. Real estate's a local business, okay? So when these are national things. So your local market or sub-market, you got to dive in. If you're buying real estate, you got to dive into that local market, what's happening there. But in general, there's still a big material gap between B rents, A rents overall. So the problem in multifamily is we need more housing. I showed that chart before. We showed we're not producing enough housing to meet the household formations that's occurring. And that's why we're having tight markets. That's why we're 97% occupied, 96% occupied in Class C properties. The bottom line is you cannot build multifamily at a level that's at BC rents. So when you build multifamily, you need the A rents to justify the cost. Costs are up materially. And that's why you see that now we're up to 87% of all multifamily built are Class A product. The other one's really tied probably to the tax credit type stuff where you have the subsidized rents. So there's an affordability problem as well. If you look at the Class A rents, you're about 35% of the area, 35% of the median household income. That's up from the low 30s overall. Class B rents, you're about 25% of the median household income. Class C rents, about 20% of the median household income. So affordability is a big issue for our country overall, but again, it bodes well for multifamily overall. So my view, how do I look at multifamily? It's a very investable asset class. We're in a stable situation. We got good economics of demand supply. And I'll touch a little bit about my view on recessions and how that fits in with what we're doing. But overall, you do have to watch out for excess supply. People make poor decisions, and sometimes they overbuild a submarket. They create too much product for the real demand in that local market. So my generalizations are the market as a whole country, but there's still going to be mistakes made. Like downtown Milwaukee, we're at 90% occupied in Class A space. It's soft. In Class A, they've built too much overall. It's actually, the market's been a lot deeper than I ever imagined it would be. Real estate's fractured, fragmented, lots of players. And there's always going to be human error in private real estate. There's just so many people in the space. There's always going to be opportunity because of that overall. So what are we doing specifically? I love buying Class BC product. I love taking that product and taking a Chevy and making it into a Buick. I like enhancing it. There's many times in the BC space, you have a clear and visible opportunity to enhance that asset, to improve that asset, to invest in the asset, and to move rents. And a lot of value creation that can have from that. I also like some Class A opportunities. When you're in a hot market, take we're in Texas here. Let's take Dallas. You take a market like an Allen, Frisco, McKinney, Plano. Phenomenal job growth in population growth in the North Dallas area there overall. But when you have that demand thing, and you have all the demand and hot stuff that's happening in that submarket of Dallas, it's really hard to keep that supply-demand balance, in balance. A lot of times, supply gets ahead of demand. Even though it's a hot market, you can build too much on a temporary basis. Now, eventually, you run out of land. And for in Allen, if you talk to the land planners in Allen, they're now requiring for their multifamily all have wrap product. Wrap product is much more expensive to build. maybe it's $225,000 per unit. But eventually, in a lot of the land that they have, they want to save for corporate relocations and commercial uses. So eventually, that changes, and the supply goes away, and demand continues. And so those are good investments from our perspective. I also love buying debt assumption deals. Now, most people don't like this because most people want to use all the creative loan products, interest-only debt. They want to create great cash-on-cash yields up front. But the thing is, if you buy debt assumption deals, your cash-and-cash yields are hurt because you're paying principal and interest, so you don't create the same, the cash-and-cash yields. But it creates an opportunity for us because we typically get between a 5 and a 10% discount on pricing just because of assuming the debt, because there's just fewer buyers that want that product. Ultimately, that debt will get paid off, and that value pop will be real and achievable to you as an investor overall. Let me get a little bit here. So let's jump to industrial. I do want to leave some time. I'm going to fly through this a little bit because I do want some time for Q&A. I want you people to pepper me with questions and then make sure I answer what you have going overall. So industrial, again, very stable. Our two favorite asset classes are apartments and industrial. In our funds, we're typically 80 to 90% in industrial assets, and a little bit in office, a little bit retail. But overall industrial, you've had a very strong industrial market. We've had rent growth about 4.8% since 2012. We're sitting at 95% occupancy, very healthy environment. You've absorbed 760 million square feet in this cycle. Again, the demand side's been very good on the industrial side overall. This kind of breaks up the industrial market into a couple different buckets. There's logistics space, which is really serving, the warehousing is really serving the e-commerce space overall, and you're seeing a lot more growth in the logistics space. But you still have a decent amount of growth in the flex, which is a blend of office and industrial, and then specialty buildings like manufacturers and all that kind of stuff. Again, a very, very healthy environment. Overall, occupancies, you're about 94% in the flex space, about 95% in the logistics space, and about 96% in specialty space, again, like manufacturing facilities and whatnot. So e-commerce is having a big impact on industrial. E-commerce is growing about 12% a year. That's creating a lot of demand for industrial space, and that trend is, I think, fully intact and not going away. So overall, demand continues to be strong, and we find industrial to be a very investable asset class. We do have to watch out in the industrial space. It's not hard to put up an industrial building, okay? A lot of guys there's a lot of speculative development in the industrial space. If there's land there and people can put a building up, they put the shell up and they wait for a tenant to show up. So there is a lot of speculative development in the industrial space, so you have to watch out for that. So when you're buying industrial, you have to watch out for the risk of new supply that can come around you and what kind of land that's available for new construction. What we like to do at MLG, the way we approach this space is, we're not, we don't do much in the way of new construction. What I like buying is I like buying existing cash flows where I think there's an opportunity to grow those cash flows and grow value. When you do new construction, a lot of times it's build and they shall come. You're taking the risk that you build it, somebody will show up and lease it. And you also got this period of no cash-on-cash yields. So my viewpoint from a risk profile perspective is I like buying existing cash flows that we can reposition. So, for example, we bought a portfolio in Cincinnati and Columbus, about 1.5 million square feet of industrial properties. Old stuff, nothing pretty. But rents, $250, $275, $3.25, $3.50 a square foot. Really low rents. New rents, $6 a square foot. But the market's 97% occupied. And we took, we have a guy that's 150,000 square foot renewal. The guy was at $275 a foot. Well, we moved him from $275 to $3.25, and he wasn't happy about that. But the reality was there was no place to go, and the market's extremely tight. It's 150,000 square feet. His rents were way below, competitive, new construction rents, and so we held firm at $3.25, and we got it. But that simply moving the rents from $275 to $3.25 creates about a 20% value change in that particular space. So real opportunity, we think, in that kind of assets. They're hard to find. It's not easy to find this stuff. We bought about 900,000 square foot portfolio in Minneapolis recently, but it's hard to find. What I also like about that is you're typically in infill locations. There's typically not much land available to build new, so you typically don't have a lot of supply risk in that particular submarkets. I love buying vacancy. If we can buy a vacant industrial building, especially when you're 95% occupied nationwide, it's awesome, and we love to find them. Again, very hard to find those. All right, so let's talk retail. Everybody thinks retail's dying, and yeah, it's challenged, okay? It's not for the faint of heart. There are challenges in the retail space. But if you look at, you're looking at you're 95% occupied. And I'm sure if I'd done the survey before I did this talk, I'm sure the votes would have been dramatically below that number. But again, you got to remember, real estate is about the basics of demand and supply. There's been very little supply creation in the last 10 years because of all the fears of retail. Population continues to grow, and that continues to create demand for retail. You're also seeing some rent pops in the 2% range in the retail space. So retail's not going away. Consumer's strong, consumer spending, and that will keep demand going. Interesting chart here. This shows the brick and mortar sales growth, roughly about 2% per year in brick and mortar. So even though e-commerce is killing it, Amazon's killing it, you're still getting some rent growth and they're getting some sales growth in the bricks and mortar space overall. So, retail's tricky. It's not dying, but from an ownership perspective, from an investment perspective, there's going to be a lot of change. And that change is going to cost you a lot in the way of capital expenditures. So, retail, I'll hit office next, but retail I would describe at this point as a high CapEx business, meaning that out of your EBITDA, out of your net operating income, you're going to spend a lot of that money as tenants' leases mature, and it's going to eat up a lot of your cash overall. We will not buy stabilized retail. Don't show me a shopping center that's 95% occupied. We have no interest in that kind of asset class at that situation. Now, I love buying vacancy in the retail space if it's in a submarket that is strong. Or I'll take turnover risk. For example, we bought a shopping center in Wisconsin, phenomenal submarket, phenomenal demographics. The 3 anchors releases were coming up in a 12 to 18 month period of time. So we're effectively taking vacancy risk. But we bought that for a 10 cap, 10 times earnings. Most multifamily stabilized, it's 7.5%, 8% cap in the retail space. So we bought that asset. We renewed. We thought one tenant would leave, which they did. But we renewed the other guys, and then we replaced that tenant. Now, there are retailers that will want prime real estate, prime locations. It's not a problem leasing retail if you're in a good location. So location matters a lot, but you have to be real about the turnover costs that you're going to have. But we also, in retail, no interest in holding it. As soon as we create that value, every shopping center that we've had, our hold period's 1.5 years, 2 years, 3 years. It's buy the asset, fix the problem, sell the asset, and go. Do not hold the asset and hold for the turnover costs that are coming eventually as things change. Because again, a lot of retailers are changing their format, and you're going to have a lot of expense as one retail guy moves out, and they got to go through the expense of re-tenanting the box that he's in. Office. Office is a tough asset class, and again, it's more CapEx, I think, than retail. A lot of turnover costs overall. There are some positives. We're 90% occupied now. We are getting some rent growth overall in office. There's some employment growth, which obviously helps on the demand side of office. Overall, demand has been outpacing supply growth in office, so that's been healthy. It's been helping the market. That's why occupancies have been improved. Overall, demand's been solid versus office. There is a trend, though, on the demand side that's not good. You're down to about 100 average employee, about 180 square feet per employee. So the trend is to have smaller workspaces, hoteling, people share desks, and there's a trend to when from home. Those are factors that are hurting on the demand side of office. One thing, this is an interesting chart, CoStar. When you're 90% occupied, it's a tenant's market. overall. Now there's exceptions. I'm here in downtown San Fran, Boston, parts of Dallas. They're hot, tight markets. Okay, that's the exception. That's not the norm. The norm is you got systemic vacancy nationwide, and it's a tenants market. So CoStar did a study, and they estimate that the cost of tenant improvements that people are spending on renewal has doubled in the last 12 years. So a tenant can demand. You got this old office space. They want you to make it new again every 5 to 7 years. They want you to. It's like remodeling your house every 7 years. And that's what happens in office space. They want this new cool space, and they make you spend the money. And when you're sitting here, you're 80% occupied in an office building, and a guy's going to fill your space up to 90%. You pay the piper to get him in because you don't have a choice. Because again, it's a tenant's market overall. This is a chart. There's a professor at the University of Wisconsin, the GrassCam program, a guy named Mark Epley. It's a premier real estate program nationwide. And he gives me some of his charts, and I like to give him credit when I use this chart. But this chart just shows how much money is being spent on CapEx every year relative to each asset class in general. And hotel and office are the highest ones. I actually think the retail one underestimates what's happening. I think retail is going to pop up because of all the changes happening in retail. But in general, office and hotel have very high capital costs in owning it. Our marketplace does not, in the valuation of retail and office, really does not price in the levels of CapEx. They underestimate the amount of CapEx when they capitalize the EBITDA or net operating income. In real estate, we use this word net operating income called NOI. It's the same thing as EBITDA. Okay. So when we value real estate, we value the net operating income. But in general, the capitalization rates that's used in valuation of office and retail greatly underestimates the CapEx elements of those two asset classes. So office, it's challenging. We're willing to invest in it, but I'm looking for human error. There's supply issues. Oh, one thing I want to mention. One reason I think office will be a perpetual supply problem is the corporate execs of the world. They love having the new sexy locations. So they leave an existing building, they leave the current office space, and it's fine, it's functional, but they want that cool new space. So they go build a brand new building, and it's really cool, but yet they leave behind this vacant space, and it happens all the time. I like to also equate it. My wife wanted to build a new house. There was plenty of houses we could have purchased, right? And plenty of houses to choose from in the price point we were looking at. But no, my wife wanted a certain way. And I love her, and it's great. But the same thing, yeah, I love my wife. She's great, awesome. But same thing happens in office. People build these new buildings. There's not need for that more space. They could have stayed where they are. We bought Harnisch-Fager's headquarters in Brookville, Wisconsin. It's a large industrial company that went bankrupt eventually. But the CEO sold the building to us for $50 a square foot, and went and built a brand new facility for $300 a square foot. And a couple years later, they were bankrupt. But anyways, it happens. So what's going on in the debt and equity side? Real estate as a marketplace is very debt dependent. People use a lot of leverage. Valuation of real estate is very debt dependent. The availability of debt is a big deal. It is very plentiful right now. There's lots of debt products available, banks, CMBS, Freddie Mac, Fannie Mae. There's debt funds. I sit on a bank board, and I will say from underwriting perspective, the banks are pretty disciplined right now. I mean, even though I say debt's plentiful, it's disciplined. I don't think it's loose. I don't think the lending standards are loose. People do remember, I think, 2008, 9, 10. So there's some discipline there, which I do think keeps supply growth across real estate overall somewhat in check. Ultimately, the lenders that are giving money out to build new stuff, if they're disciplined, that'll help keep supply in balance. And I do think that's pretty much in balance. Credit spreads are decent. There is a ton, switching over to the equity side, there's a ton of capital chasing private real estate. A lot of the pension funds, insurance companies, they have liabilities they need to meet. Pension fund allocations we're seeing going from maybe 5% up to 12 to 15% private real estate. And you're seeing an increased attention towards private real estate to create yield overall. Closed-end funds, a lot of capital has been raised to invest in private real estate. You're sitting with over $300 billion of funds available in private equity funds for buying private real estate. A lot of folks chasing yield overall. This is a chart that's kind of interesting. It just shows value appreciation over the last 20 years. Again, I like looking 20 years because I like to get through pre and post the 2009 recession. Overall, about 4% on gross values over the last 20 years overall. One thing you'll notice here, and I'll just bring it up since in the context of David's presentation, we had that recession in 2001. My viewpoint is most recessions are manageable for real estate guys. You just go kind of flatline. And if you watch your leverage, you're not over levered, you can manage through most recessions. 91 was not hard to manage through. 2001 was not hard to manage through. Mid-80s was tough. 2009 was tough. But both in those cycles, mid-80s and in 2009, there was government policy decisions that created major supply and demand imbalances. And I was a tax guy with Price Waterhouse out in San Francisco in the mid-80s. But when they changed the tax law and they put the passive loss rules in place, and they did it prospectively, they did it retroactively versus prospectively, we had all the supply that was sitting out there and it was created, and there wasn't really real demand. All these real estate deals in the mid-80s were being created for tax benefits, and there wasn't really real economic demand. So as good as Reagan was in some regards, there was a misstep, and when they changed the rules, they should have done prospectively, not retroactively. So the policy decision in the late 90s to make easy money for single family caused the disruption. So I don't see overall any major supply demand imbalances like we saw in the mid 80s or the early 2000s, the single family boom. I don't see that in the market, but there are concerns overall. Interesting in this chart here, it shows. Look at the chart on the right. The ones on the left are a little hard to work through, but on the right you just see that just shows what cap rates are doing in the various asset classes. And in general, you see them declining and then flattening out. Now, if you recall the last, this is over the last since 2013, and we've had the 10-year Treasury swing, from 1.5% to over 3%. You're not seeing that in the cap rates, right? And so a lot of people think interest rate volatility is going to immediately impact cap rates. It's a misnomer. It's not fully understood. There's lots of factors that go into it, but that's an interesting chart to kind of demonstrate that. This chart talks about the difference between cap rates and the 10-year Treasury. Really, this volatility you see in this is really driven by the 10-year Treasury bouncing around, not so much cap rates overall. So I'm going to run big through this. So overall in the capital markets, there's lots of equity out there. It's great being a seller. I love selling right now. It's so fun. It's great selling. It is hard to buy. It is really hard to buy. So your sourcing strategy is very important in trying to create do smart deals. I was just talking about cap rates there and valuation. When we talk cap rates, it's the opposite of PE, price earnings ratio. So we take our net operating income, or EBITDA, and we divide by a percentage. So typically 6% cap rate means it's about 16 times earnings. And so we take the NOI and divide by a percentage to get to valuation. So we do the opposite of the stock guys, but it's the same mathematics, just inverted using dividing by a percentage. But overall, my belief, cap rates are driven by debt constants. So if there's plentiful debt available, and you can get interest-only debt, which has been common, you don't see a big movement in cap rates, because if you're borrowing money at 4%, 4.5%, or 5%, or 3.5%, that's still creating positive leverage to the cash and cash yields if you got interest-only debt. And that's why flat rate, in my viewpoint, why cap rates have been relatively stable and declining is because of the availability of interest-only debt that's out there, and that overall. But in general, as rates go up, the spreads, typically right now you're looking at spreads of 170 to 2.25 over the 10-year Treasury. So with the 10-year Treasury at 175, add 2%, you're borrowing money at 3.75%, right? But if you go back to 2004 when the 10-year Treasury was 4%, the spreads were 90, 100 basis points, 110 basis points. So even though a 4% Treasury got you about a 5% borrowing rate, and today with from 4% down to 1.7, you're at 3.75. So you don't have as much volatility in your debt rates, and then combined with the creative debt vehicles, the cap rates aren't as volatile as one might think overall. There's some mathematics that went through. I'm a numbers guy. I mean, I have 8 CPAs on my team. I'm a CPA myself, and so a little math gymnastics. But our mathematics show that if you go from a 1.6% 10-year Treasury, now this is totally contrary to David. Now we're going to 0 on rates, but if you go from 1.6, people are fearful of rates going up, right? And David would say otherwise. But you go from 1.6 to 3.8% 10-year Treasury. Our belief, I mean, that will impact cap rates some, not as much as you think, but we think we only need about 1.6% per year of revenue growth, which increases your EBITDA, net operating, and that creates value growth to offset that change. And if rates go up, it's going to be because there's inflation. That's what would cause rates to go up. And you don't need that much inflation to offset the effect of value impact. So real estate works it's pretty cool that way, and it works as a nice hedge against inflation if there ever is any. Overall, prices things are fully priced. I mean, it's a very stable market. People might call it frothy, but the reality, I think it's reasonable relative to where interest rates are. Our viewpoint, that chart showed previously the prices have gone up about 4% a year over the last 20 years. A lot of that has to do with cap rate compression, meaning as rates went down, cap rates went down, and the values go up just intrinsically because interest rates are lower. In our viewpoint, David might correct my viewpoint, but our viewpoint is that cap rate compression value thing, you don't count on that going forward. And if we get some lower rates here, in long term, that could be different. But our viewpoint is we're assuming that cap rates are relatively stable. And if we want to create value, we're going to have to do something to that operating income. We're going to have a strategy to grow our NOI. We're going to have a strategy to grow our EBITDA. We're not going to create value just by buying it. We have to have a proactive strategy to buy stuff. Everything we do, we're focused on buying assets where we can take that income and grow it one way or another. So I'm going to share with you a little bit of how we source deals, because in private real estate, the sourcing function is critical to creating. How do you find these deals? It is not an easy game overall. So my team, we have over 400 people. We have roughly 30 people that are in the chase of commercial real estate that are part of the acquisition team and finding opportunities. In Wisconsin, Texas, and Florida, we're your typical real estate operator. We fix toilets, we shovel snow, we cut grass, we evict tenants that aren't paying rents, we lease to new tenants, we lease vacant spaces. We're your typical real estate sponsor in Wisconsin, Texas, and Florida. And coming out of the downturn, one of the blessings of going through 2009 and 10 is that we sat back and said, well, how do we do our business better, smarter? And what we did coming out of that cycle is said, you know what? We need to expand our geography. We need more opportunities from more states. We can't just rely on our historic markets overall. And so what we did is we actually started doing JV equity. And what I mean by that is we proactively invest with other real estate sponsors. We travel the country. We go to a market like Minneapolis, and we identify the 60 real estate guys in that marketplace and say, hey, Joe, real estate guy, I got 10 to 20 million right now to invest in Minneapolis. What do you got going on? Real estate guys meet with us because we have the money. And from that, we have over 1,000 real estate companies that we talk to around the country. We're chasing in middle America. The coasts are kind of nuts. Too much capital chasing the coasts. We stay in middle America, and we invest with the local guy. And the reason we do that is I cannot match a local guy that's been in Minneapolis for 30 years. I can't match his 30 years of relationships. And I can go there, I can hire a guy, but I can't really get the 30 years relationship. The deal, Crossroads deal, that we were all in for $58 million, sold for $95 million in 3 years. I didn't find that deal. It's a local guy named Jim Soderberg. He grew up in Minneapolis, 30 years in the business. He knew the gentleman that owned the asset. The guy lived in Naples, had no debt, had income of $2.5 million a year. Life was good. But I never would have saw that deal if we weren't willing to invest in other real estate guys. So about half our business today is doing JV equity, where we proactively invest with other real estate operators around the country because they have those local relationships. They're going to find that human error, those mistakes, those off-market deals that I can't replicate because my team doesn't live there overall. So I want to talk a little bit tax, just because I'm still a junkie when it comes to taxes. I can't shake it as an old tax guy from Price Waterhouse. 1031 is a tax law that allows you to trade and not pay tax. It's a great tax law, way overused. I'm in the space, I'm a tax guy, I probably trade 10 to 15% of the time. When you have that lunar alignment of selling a deal that's at a great price, can you simultaneously at the same moment find another great deal to invest in? And many people make really poor investment decisions where they trade into a garbage piece of real estate just to not pay tax overall. Opportunity zones. Again, good tax law, very, very beneficial. But I have some fundamental concerns about that space because the concept of an opportunity zone is there's something wrong with the demand side, right? There's something struggling about that submarket. So there's, in theory, demand issues in that space. And so now you're going to flood an area that's got demand problems with a bunch of new supply. I mean, that's just poor economics. And so there's going to be exceptions. There's going to be opportunity zones where it probably shouldn't be an opportunity zone. And the math's going to be good, and you should do the deal. My contention is you should only do direct investments and specific co-investment offerings, specific deals. I would not suggest investing in funds because I think you're going to have a really hard time doing enough deals in volume in the opportunity zone space. And I think there's going to be some real mistakes that are made there. If you're investing in other real estate guys, you need to be asking them, are they doing cost segregation studies? All that is when we buy an apartment like an apartment complex, we value every little thing that's in there. In our funds, we're typically creating, if you have $1 million investment, typically creates losses about $400,000 to $500,000, 40 to 50% of your investment in the first year. And we get that because we do cost segregation studies. If you're a real estate guy that you're investing with does not do cost segregation studies, demand it. We think it adds about 1.5% to 2% to your after-tax yields. 1.5% to 2% per year. If you're at the highest tax rates, that math to work, you got to be at the highest tax rates overall. And we do this JV equity program, right? We invest with a group that they have 80,000 apartment units. They've never had done a cost seg study before we invested with them. Never. And they've been in business for 40 years in the multifamily space. So it's sinful if they don't take advantage of it. It's free money from the government. The other thing, to really take advantage of it, you need to be willing to sell. Because if you sell, you create capital gain income. That's passive capital gain income that allows you to use those passive losses. When we create losses, many of you won't be able to use them immediately. But if we sell an asset 2 years later and I allocate cap gain to you, now that passive, I give you $1 million. I had a neurosurgeon invest a fair amount with us, and he had basically $2 million of cap gain with us and $2 million of ordinary losses with us. That saved him like $600,000 on his tax return, and it was net zero net taxable income. So it's a very powerful tool to be used, but again, you have to creating the passive capital gain income is a great complement to it. So that's I don't know how much time I have, but I tried not to talk too long. I talked longer than I thought. Gosh, time goes fast. But anyways, questions?
Yeah, I got one.
Sure.
In your typical investment or multi-housing, what is the occupancy rate have to be in order for you to just break even?
Well, that's a lot of us about leverage. Our target leverage is between 60 and 65%.
Okay, there you go.
Most real estate guys, you can do max leverage. You can do 75 to 80% leverage, right? If recession comes, you're not going to be like being at 80% leverage if recession hits. So our target fund, our leverage is lower than most guys. Most people made their money in life. They're not looking to bet the shop. So we target 60, 65% leverage. But we still hit in Fund 1, Fund 2 over 20% annual rates of return at those leverage points overall.
I had one question for Tim, and that is your competition. How much of that competition in the commercial real estate area do you see more highly leveraged than they should be?
We talk about our JV equity strategy. We're talking over 1,000 real estate guys around the country. We're seeing about 60 deals a month. Okay, 60 deals a month. We're hoping to invest in 1 or 2 of those 60. So a real critical selection process. I would say at least half of them that come in on those 60 want, at least 70% leverage, but commonly 75 to 80% leverage. And so when we look to invest in them, we say, listen, we'll do this deal, but we're going to bring your debt from 75 down to 65%, and we're going to give you the equity too. And yeah, it's going to hurt your rates of return. It might hurt how much money you can make on the deal, but we don't want that leverage if we're investing in this deal.
What do you see in the REITs? Are they buying or selling? And if they're selling, why are they selling?
REITs, what you have in the REIT space, I mean, they're like any other public company. They got to create earnings. So REITs will sell their assets to create, some income and stuff on their stuff. My belief is REITs are not private real estate. It's a very different asset class. Private real estate's only got about a 0.3 correlation ratio to the S&P 500, and public REITs have a very high correlation rate to the S&P 500. I have no problem investing in public REITs. Just don't think you're investing in private real estate when investing in in public REITs. They are a very different asset class, in my viewpoint.
Are they getting pressure to sell?
I think there's some pressure. Like for example, some of the apartment REITs are getting pressure to sell their old stuff and buy all new stuff because the institutional money wants to be in newer stuff. So there are some pressures to turn over their portfolio if it's aging. And again, there's pressure from an earnings perspective in the public marketplace to create earnings. So you will see some sales because of that.
Think of Dayton's scenario. What's this asset class going to do if the 10-year goes to zero and we go into a recession in the next?
So if you look back to the 91 recession, 2000 recession, it was, if you look at that chart, I showed the price appreciation. Prices were flat during the early 2000s. It didn't go down. It was flat. Now, if we get a deep dive like 2009 or we had the mid 80s, there'll be value drop. I think the value drop's much greater in the stock market. And in fact, I could make a strong argument that if rates go down more, then our borrowing costs they'll go down as well. So we have some things in private real estate that hedge against that just naturally, overall. You're right.
Two questions. First one is, can you talk about the K1 and options you have that are not K1?
So we have two feeder vehicles in our fund. We have the traditional LLC structure, which is your max tax benefit. If you're highly compensated and you're investing enough money in private real estate, you should be investing in that to take advantage of the cost segregation studies. We have another product, though, which is a non-traded REIT vehicle that feeds the same fund. And by investing through a non-traded REIT, that converts the rental income into dividend income, which means that you don't have multi-state filing. You get K1s, but you don't have all the multi-state filing overall. And it also avoids UBTI for foundations, endowments, and retirement accounts, which is greatly ignored many times by a lot of folks. So we have two ways into the fund overall. And also we target, because I have an old tax guy, we target K1s by March 20th. And in fact, in my legal documents, people have to give us K1s by March 1st, otherwise I can fire them as a manager when we invest with them. So I'm real anal about getting K1s out on time.
One other question, Tim. When you talk about retail rents, are they really up, or is the rent increase the TIs that people are having to do and then put that in the rent? Because I haven't seen any rent increases in unchanged, like renewals, have all been flat to down.
That rent growth is probably more driven by cost growth, was what you're implying. To the extent that you have cost appreciation, cost new construction, tenant improvement costs, that's probably what's driving the rent growth. You're on point there.
Well, you got a big slug of real estate here. Oh, we've got a question back over here.
So, in your new construction projects, are you taking into account or doing anything regarding automated vehicles and future different perceptions of how that will impact the project?
Well, first of all, we don't do a lot of new construction because I don't like the risk profile. Unless you have a tenant signed up, I'd like to buy existing stuff. Obviously, like the trends in office where people are working from home, hoteling, smaller workspaces, trends like that are impactful. The whole automated car thing and what's going to happen in retail. That's why, for retail, it's not going to change that fast. It'll change, but if our hold period is only 2 to 3 years in retail, I'm not going to have to worry about that issue. But long term, we have to be watching what's happening, and a lot of crazy stuff coming our way, and technology. God only knows what's happening, 20, 30 years from now that we'll have to deal with.
Yeah, I think what Fred was talking about was, in California now, they're building a lot of homes with no garages. That's kind of a fad that started out there because they think that you won't have a car, or if you do have, somebody will self-drive you somewhere. But
Okay, sorry, I didn't get
yeah,
that.
but a lot of it's coming from. I think it's a long way off, probably. But
Yeah.
that's where we are. Any other questions? I know it's really interesting talking about what
There's
you
one
talked
over there.
about today.
I know you mentioned, everybody knows kind of e-commerce is here to stay, but any correlation with, if we do have a recession, the amount of maybe luxury goods and not necessity goods that get delivered through that will impact industrial? I mean, if e-commerce goes down, now there's pretty
Well, industrial is going to be more impacted by what's happening in the retail space now, right? It's going to have a flavor of retail because of what's happening overall, and especially in the logistics type space, overall. Again, those trends, we just have to watch it, For me, the stuff that Dave was talking about is big and important. We're kind of in the weeds, right? And we're looking at local impact and what's happening in very narrow local submarkets because we're looking to buy an asset, fix it up, sell it. And those mega trends are very real that we have to watch. But in the hold periods that we're looking at, we're not having to worry so much about a trend like that, but it will eventually get its way into the marketplace overall. And industrial will be more impacted by retail type stuff.
Tim, thank you.